You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Tesco's, easyJet, ASOS, Oxford Biomedica, Nestle and Netflix. And it's the 23rd of April on the date of recording. So Tesco's, Britain's biggest supermarket, had their full year results out last week, with full year group sales, excluding fuel and VAT, up 3% to £54.8 billion, with growth across all regions. Underlying operating profit was up 58.9% to £2.8 billion, with reduced COVID costs and Tesco's Bank returning to profit. If we break those results down a little further, in the UK and the Republic of Ireland, retail sales came in at £50 billion, which is up 2.2% on a like-for-like basis. This was helped by the rebound of Booker Catering with a return of hospitality after COVID, with like-for-like sales increasing 56.1% to £2.9 billion. Sales growth in the UK itself grew by only 0.4% on a like-for-like basis as more people returned to eating out by the final quarter. And whilst the group highlighted cost inflation, reduced COVID-related costs meant that underlying operating profit increased by 35.4% to £2.5 billion. Online sales fell by 6.5%, with consumers returning to in-store shopping as the pandemic eased. However, sales are still 66.1% ahead of pre-pandemic levels, completing 1.2 million orders per week, up 0.9% on last year, but with a 6.8% smaller basket size. In Central Europe, like-for-like sales grew 2.9% to £3.9 billion, with growth across all regions. Underlying operating profit was up 41.1% to £168 million, with reduced COVID costs and better sales. The Tesco Bank increased revenue by 25.4% to £922 million, with the acquisition of Tesco's underwriting. Excluding this, revenue actually fell 9.4% as consumers paid down debt and increased their savings. However, the increased bad debt provisions have been released in the last year, and this has helped profits reach £176 million compared with a loss of £175 million last year. Retail cash flow came in at £2.3 billion, up 69.9%, with reduced pension contributions and improved profits. Net debt was down £1.5 billion to £10.5 billion, with the ratio of net debt to cash profits at 2.5 times compared with 3.3 a year earlier. Alongside these results, the board warned of significant uncertainties in the external environment, with underlying operating profits expected to fall and come in at between £2.4 and £2.6 billion, with ongoing inflationary pressures. The board also announced a final dividend of 7.7p and a further buyback of £750 million of shares over the next 12 months. And shares were down around 5% on the news. In terms of valuation, Tesco's has a market cap of around £20 billion and trades at 12 times earnings, which is broadly in line with its 10-year average, and it yields a prospective 4%. I thought these were really excellent results, and I think Tesco's is in a very strong position, even taking into account the inflationary pressures. It's the market leader and has scale and pricing power ahead of any of its competitors. Its balance sheet is also strong, and I think the current macroeconomic situation is probably accounted for in the share price. I suppose it's that profit warning that goes alongside these results, which has really spooked the markets, and the sort of the inflationary pressures that we know about. But I think in the sector, Tesco's is the best business. I think there's a lot still to be said for it. I think they're not going to make the mistake of aggressively raising the prices like they did after sort of 2007, 2008, which allowed Aldi and Lidl into the market. But I think even if you take that into account, with the efficiencies that they have, I think it's the best in the business. And even if it's not growing revenues at the rate that we might have hoped, it's at 12 times earnings with a yield of 4%. It's pretty good. What are your thoughts, Sam?
Similar to you, I do think the revenue growth was slightly disappointing, but I mean, it is on the back of a very, very good year, and they have beat the COVID figures. The operating profit growth is fantastic, and that's now reflected in the fact that the PE actually looks quite reasonable for the first time. I think we've probably covered it. I know the share price has come down a bit as well since, I'll just get it up, but since we last looked at it. So it's trading at 265p a share, and that compares to a 52-week high of 304p, which was set in December, January. I think at a P of 12, I think it's actually pretty fair now. The dividend yield's very good. I agree, it's best in class. Yeah, I like it. I agree with you. I think it's a good business.
Would you be buying any shares, holding shares?
I don't think I'd buy any, but that's more reflective of my age in my portfolio. I don't see where the growth really comes from. But if for example, I was like older and my portfolio is more geared towards income, that 4% yield's pretty safe. I'd be very comfortable having Tesco in there as part of a high yielding portfolio. So for me, I think the opportunity cost is too high, and I think I could probably get more growth from other stocks. But I think for someone who's maybe more interested in income or even just slightly lower risk than me, I think they do very well to consider Tesco.
Fine. Okay.
What about you? It's in your portfolio, isn't it?
It's been in my portfolio since, I don't know, 2013. Yet to make a profit on it, but anyway, we're close to breaking even. And
we've had the dividends.
I've had the dividends, but I'm talking about even if we include the dividends.
Oh.
So yeah, the dividends were slashed back for a long time. So yeah. Anyway, I'm happier holding it now than I've ever been happy. You know, apart from maybe when I purchased it for a few months or the first year. I'm happier now than I have been in a long time with it. So yeah, I'm just sitting in the portfolio, and maybe one day in the next few years I'll break even on it. But
so did you buy it before or after the accounting and the horse meat scandals?
So in between.
So which one was first?
So the horse meat was first, and then the accounting was second.
You thought, how much lower can it go?
Yeah, that's right. So I was like, oh, well, I'm going to get a lower price than Buffett got it at. But anyway, he got out of it and I stayed in it. So yeah, I'll just, I must have bought it. Let's see roughly what the price was. I think it was in the high 370s, something like that. I don't think it was, it could have been, in fact, maybe it was over £4 a share. I don't know. It's been a while. I don't. Yeah, it's a sore point. But
would you consider adding to it then?
I don't think so. I think I'm happy with where it is now. There were times when I considered adding to it. I think back when it was about £1.30 a share, and Mike Ashley was picking up some Tesco's, but I don't think so. I think I'm happy with where it is in the portfolio. It doesn't make up a big part of it, and just leaving it there, reinvesting in dividends, and the fact that it's a much healthier business now than it has been previously. Like to see it doing well, of course. Should
we move on to a business that you probably won't be adding to your portfolio anytime soon?
Well, we don't know. easyJet.
I'll be surprised. So easyJet have come out with a trading statement for the half year prior to the half year results, and they've said their plans to reach near pre-pandemic capacity by the summer are unchanged. The group also said first half losses of 535 to 565 million have reduced compared to last year and were better than expected. Johan Lundgren, CEO, said since travel restrictions were removed, easyJet has seen a strong recovery in trading, which has been sustained, resulting in a positive outlook for Easter and beyond, with daily booking volumes and summer currently tracking ahead of those at the same time in the 2019 year. The group's strong trading partly reflects positive ancillary revenue, with revenue per seat sold rising 57% to £19.56. In the second quarter, easyJet flew at 67% of pre-pandemic capacity, which is in line with the expectations. In the same period, planes were 78% full because of the effects of Omicron. In Q3, capacity is expected to reach 90% of 2019 levels. Passenger numbers rose significantly in Q2 from 1.2 million last year all the way up to 11.5 million. The group highlighted 64% of its fuel for the second half is hedged, which means it's less exposed to the current elevated price. easyJet also highlighted it has very little exposure to Eastern Europe and expects little to no impact from the ongoing Ukraine crisis. The group sold and is leasing back 10 aircrafts, generating cash proceeds of $120 million. As of the end of March, there was net debt of, that can't be right. It says net debt of 0.6 million, down from 0.9 million. I'm going to have to load up the trading statement because it wouldn't surprise me if that was a typo and is meant to be billion. It's not even worth mentioning otherwise. Yeah, it should be billion. It's down to 0.6 billion from 0.9 billion. So in terms of the valuation, still not making a profit. Price to book is 1.56, and that compares to a 10-year average of 2.22. And there is now a prospective dividend yield of 1.8% for the next 12 months. My thoughts on this trading statement, it's obviously better than it was. It's still not, for me, an investable business. The problem is even if they were at 100% capacity, I don't think airlines would ever be an investable business for me. There's so many unknowns with it. It's always at the mercy of external factors. Like, for example, the fuel. I know it's hedged for the second half, but then what about that? At some point, the higher prices are going to hit it, and that's not going to be particularly good. Any kind of new variant or anything like that, it's going to get hammered. And then even at the best of times, it's a very, very tough industry to be in. Plus, if you'd been a long-term shareholder of this business, you have not done well, because they had to do a 1.2 billion rights issue to survive the pandemic. So I think it's a very interesting stock, and that gives you a good sense of how the wider economy is doing. But I don't think this would ever even make it to the watch list. I don't think I'd ever consider this kind of business investable. What about you, John?
No, exactly the same. Not investable, and for the same reasons. I wouldn't even look at it any further.
So hypothetically then, how do you feel about it going forward in terms of the fuel costs and all that stuff? Do you think?
I mean, it just can't be good, can it? It's well, yeah, like you say, they're hedged in the short term, but in the longer term, I mean, it could be an absolute disaster. And if oil's above $100 a barrel, or continues to be above $100 a barrel, I mean, it's just disastrous for it. I suppose on the positive side, you might say, well, post-pandemic, things are normalizing and people are wanting to go on, cheap European holidays again, which is good for the business. But I mean, that's about the only tailwind it has.
You'll pardon the pun.
Yeah, exactly. So yeah, not for me.
It's just a commodity as well, isn't it?
Yeah,
it's not a commodity they ever seem to make any money on.
No, exactly. At least with regular commodities, you
yeah.
do. I mean, we were quite bearish about, or we had been quite bearish about Shell previously, but
they do turn a profit every now and then.
Yeah, well, when times are good, I'm looking forward to seeing what the Shell results are.
Yeah, whereas when times are good with aircraft travel, it's still not a guarantee that you'll get good results.
Yeah, I think the difficulty with Shell and BP, but I think particularly with Shell, is going to be the calls to the windfall tax, and it depends what the political situation is at the time. And I think that is the one worry. But no one was being sympathetic to Shell or BP when the oil price was the $20 a barrel.
I know they were losing an insane amount.
Yeah, they were losing an insane amount, and no one was like, oh, we better come and bail them out or give them a free state loan or something. That wasn't happening. So when times are good, they just get bashed. So yeah, it's difficult politically, but people don't have much sympathy for them. So I
don't think we need to worry about a windfall tax for the airlines anytime soon.
Well, yeah, exactly. So anyway,
Should we move on to ASOS?
Yeah, so I suppose that's somewhere in between easyJet and Tesco's. The online discount fashion retailer had the half-year results out this week, with half-year revenue up 4% to £2 billion, with the UK growing at 8% and the US at 11%. However, increased supply chain and inflationary pressures led pre-tax profit down from £112.9 million to £14.8 million. If we break those results down a little bit further, the UK saw total sales rise 8% to £895.5 million, with a 13% increase in active customers, which was helped by the strong performance of the Topshop brand, Face and Body, and sportswear. The group was forced into dropping prices to shift slow-moving stock from last spring and summer, meaning that average basket size value fell 4%. In Europe, sales grew at only 1% to £577.4 million, with customers returning to bricks and mortar retail. Active customers did rise 6%, however, and again, the sportswear performed strongly and the Topshop sales more than doubled in Germany. Similarly to the UK, average basket size value fell 3% with price reductions. In the US, sales were up 11% to £252.7 million, but due to supply chain challenges, ASOS couldn't actually fully service the demand. Encouragingly, again, the Topshop brand went down well with US customers and sales more than doubled. Average baskets value grew 2% and active customers came in 6% ahead of last year. In the rest of the world, sales were down 10% to £278.5 million, with a lack of availability due to supply chain issues and a return to bricks and mortar retail. Overall, gross margins fell 1.9% to 43.1%, and price increases were implemented in the second quarter to help offset the increased costs and higher clearance sales. Operating expenses were up 11% to £867.6 million, and distribution costs notably rose, particularly with wage inflation in warehousing and return rates continuing to normalise, which were both bad for margins. Net debt came in at £62.6 million, and there was free cash outflow of £256.6 million. Alongside these results, management warned that the full impact of recent inflationary pressures on consumers and the potential impact of discretionary spend are yet to be felt. However, full year guidance remains unchanged. In terms of valuation, ASOS has a market capitalisation of £1.4 billion and trades at just under 16 times earnings, compared with a 10-year average of just under 52. Currently doesn't pay a dividend. I thought these results were disappointing, especially for a growth-orientated online fashion retailer. And I do think in the near term, there are serious concerns about the supply chain and inflationary pressures impacting on margins, particularly if sales growth is slowing too. Whether occasion wear will recover and deliver growth as COVID restrictions are disappearing in the slightly longer term, and the fact that ASOS is more value orientated than some of its bricks and mortar competitors that sit in the middle of the fashion market is something that I think we're probably yet to see. And it still retains strong brands like Topshop, which is, in ASOS's favour. I don't own ASOS myself, but I do have Boohoo, as I know you do as well, Sam. And it's not a dissimilar story, although I think the Boohoo numbers so far have been a bit more robust. I probably wouldn't be buying ASOS shares at the moment for those reasons, but if I already owned ASOS, I'd be holding it for the longer term for sure. What do you think of these results, Sam?
Similar to you, I'm probably more sympathetic towards the results just because I think these aren't fantastic results by any means, especially compared to the numbers the businesses, the market's become accustomed to the business putting out year after year. But we'd already had however many trading statements. We knew the results weren't going to be good. I don't think they're any worse than the trading statements indicated. So this shouldn't be a surprise, really. And then as well, there's a couple of encouraging. I think the supply chain problems are not great, but they're very temporary problems. In 2 or 3 years, we're not going to be talking about the supply chain anymore. And I think, has anything actually changed for ASOS as a business in the last 6-12 months? And I would say not. And this is a business that's come down from, it was trading at over £50 a share. It's now at 14. I don't think, I'm not going to work it out, but say that's a 70% drop. I don't think it's 70% worse as a business. Now, maybe the valuation was a bit high, and I know that we talked about when we covered it on the show, but I think a PE of 15 is extremely cheap. And then when you're looking at it as well, it is in a position where once the supply chain issues have been sorted, it can just return to growth. I mean, the fact that in the US, they could have sold more, but they couldn't get the stock there because of supply chain challenges. So they, like, when they're in a position where there's regions where they can't actually service the full demand, for me, that's quite an encouraging sign, because once the supply chain issues are sorted, and I think they will be, I would expect the growth to reaccelerate. And once the growth reaccelerates, I'd be quite comfortable the multiple's not going to stay at 15 for very long. So if I was a shareholder, I would be perfectly happy continuing to hold. It's still profitable. There's no issues in terms of like the cash flow or running out of cash. It is in a good position to weather the current storm, I think. So that being said, I agree with you. I think Boohoo's the better business, and that's why we own it. But I would be perfectly happy continuing to hold ASOS. I wouldn't be too happy if I'd bought it at 50 quid, but I mean, there's nothing you can do about that now. I think it's a very, very fair valuation.
But if you didn't hold any of these businesses and you were going into the market, would you rather have Next compared with ASOS at the moment, or Associated British Foods, for example? Would either of those, how would that change things?
I mean, I don't think it'd be terrible to take a basket approach. You could do ASOS, Boohoo, Next, and ABF. I would back that to beat the market over the next 5 years, that little basket. But if you were going to pick one, again, ABF and Next are probably more similar businesses. I know Next is much more online, and Primark's not online at all, but they're more traditional. They're not the high growth, fast fashion brands that ASOS and Boohoo are. So maybe you could just do one of each. I think Next and ASOS would take up very different positions in the portfolio.
Sure.
ASOS is much higher growth, potentially much higher risk, but if they can return to previous levels, I mean, even to just get back to £45, which is still like 10% off where it was a year ago, you're looking at a 3-bagger. Sure. Next is a fantastic business. We both really like it. We've covered it on the show recently, and it's down about 25-30% from where it was a year ago. But even still, I don't see a scenario where you invest in Next and it's a 3-bagger in the next 2 or 3 years. Whereas I think you have that possibility with ASOS. The problem is you also have the possibility that you could go and lose another 70%. That's part of the fun though. Whereas with Next, I think stuff would have to go really wrong to lose another 70%, but you're probably not going to get a 3-bagger anytime soon. What about you?
Yeah, I mean, I do agree with that. And out of the 3, I suppose 4, I did go ahead and buy Boohoo. So that's my answer.
I've got Boohoo. I thought seriously after last time we covered it about adding Next. I haven't done it in the end, but I wouldn't be looking. It wasn't because I was looking at my portfolio and saying, well, I've already got Boohoo, so I can't have. I'd view them as very different businesses, really. Like,
sure.
Right. Should we move on to Oxford Biomedica?
Yes. So tell us about it, Sam. It's a business that I don't know very much about.
No, me neither. So this is from the About page of their website. But Oxford Biomedica is a leading, fully integrated cell and gene therapy group. We have built a sector-leading viral vector platform, including our lentiviral vector delivery system, LentiVector registered platform, which we leverage to develop in vivo and ex vivo products, both in-house and with partners. We've also created a valuable proprietary portfolio of gene and cell therapy product candidates in the area of oncology, CNS disorders, and liver disease. Based on our world-leading position in lentiviral vectors and success in the adenovirus vector-based AstraZeneca COVID-19 vaccine, we have demonstrated the versatility of our platform and have extended our scope to all types of viral sectors. Oxford Biomedica has a number of further partnerships, including with Novartis, Juno Therapeutics, Bristol Myers Squibb, Boehringer, Ingelheim, Beam Therapeutics, Arcalyx, Cabaletta, Oxford Therapeutics, and Santen. Additionally, we have a 3-year master supply and development agreement with AstraZeneca for large-scale manufacturing of the adenoviral-based COVID-19 vaccine. Oxford Biomedica is based across several locations and headquartered in Oxfordshire, UK. That's where you are, isn't it, John?
It is. I should
keep an eye out for them.
Yeah.
In early 2022, Oxford Biomedica announced that it was broadening its leading viral vector offerings by incorporating Homology Medicine's established AAV capabilities into a newly formed AAV manufacturing and innovation business, Oxford Biomedica Solutions, based near Boston, Massachusetts, with Homology Medicines as a 20% owner. I won't carry on, but it's quite a complicated business, so you can already guess that this is going to end with me saying it goes in the too hard pile. So they have come out with full year results, and total revenues increased by 63% over the 2020 levels to 142.8 million, and that was up from 87.7 million in 2020. Revenues from biopressing and commercial development grew 87%, driven by large-scale commercial manufacture of Oxford AstraZeneca COVID-19 vaccine. Revenue from milestones, licenses, and royalties decreased by 25% to 14.4 million. Operating EBITDA and operating profits improved by 28.5 and 26.5 million respectively, with the group generating operating EBITDA profit of 35.9 million and operating profit of 20.8 million. Cash generated from operations of 24.5 million was up from 3.9 million used in operations in 2020. And this increase is a result of the vaccine manufacture for AstraZeneca, offset by further operational investments required. Gross proceeds of 50 million were raised for a placing with Serum Life Sciences in 2021 to develop the fallow area of the Oxbox manufacturing facility. Cash at 21 December 21 was 108.9 million and 144 million at 31 March 2022 after an $85 million loan facility was drawn. They have given a gene therapeutics update, and they've said that for proprietary in-house product development, the lead program, the OXB302, which is acute myeloid leukemia CAR-T therapy for AML targeting 5T4, preparation for clinical trial initiation is ongoing. For liver gene therapy, they've said liver is an attractive target for lentiviral vectors due to the potential one-off therapy to give a lifelong benefit. And in vivo CAR-T generation for greater patient access and superior efficacy. Efficacy? Is that a word?
Efficacy.
What's that mean?
Effectiveness.
Oh, right. I thought it was like a typo for efficiency. Right. Okay. Off the shelf, reduced COGS direct reprogramming of patient cells. And then in the AXO-Lenti-PD-Parkinson's disease section, it said on 31 Jan 2022, Oxford Biomedica was informed by CO Gene Therapies of their intention to return the rights for AXO-Lenti-PD. We plan to license out the program again to a suitable partner. And in the outlook for 2022, they've said overall revenues are expected to be lower than 2021. Vaccine manufacturing volumes are expected to be substantially lower in 2022. Discussions continue on a potential extension of the 18-month supply agreement with AstraZeneca. They've accelerated investment in R&D in order to maintain the competitive edge and build a leading position in AAV, in addition to lentiviral sectors. Growing customer base and new base in the US puts Oxford Biomedica in an ideal position to maximize growth and achieve its goal of becoming an innovative global viral vector leader. If you look at the results for the past 5 years, revenues increased from 37 million to 142 million. However, that's a big jump in the last year from 87 to 142, which is presumably because of the AstraZeneca vaccine. And it's not really flowed through into operating profits prior to last year. So although revenue from 2017 to 2020 was up from 37 to 87 million, it was still an operating loss of just under 6 million. And then that's jumped to an operating profit of 20 million last year. In terms of the valuation, the business is currently trading at a PE ratio of 24.59, and the valuation is 552 million. The shares are currently at £5.75, and that compares to a 52-week high of £16.78. My view is this is still quite an expensive business. I think a PE of 25, when we know revenues are coming down, a lot of the increased revenues have just come from the AstraZeneca vaccine. And as we move towards a post-COVID world, I think that's going to be less important. I think as well, this is maybe getting slightly, but I don't see a world where people continue to go out and get a vaccine every 6 months. So again, I think eventually, I just don't see, if that's making up such a big proportion of the revenue, which you can tell by the jump in the numbers, it obviously is. I wouldn't be particularly happy about holding this business. And then if you look at the results before the vaccine became a part of the business, they're not particularly great. Even if I was looking at this and thinking the results looked amazing, I really like the pipeline, which I don't really understand. But even if I did really like it, I would probably still be looking and thinking, well, this is going to have to go in the too hard pile anyway, even if the results are fantastic. And it looks like, from a numbers perspective, the best business in the world. So it looks like they're in. Do you know where Windrush Court is, John?
I don't actually.
So that's where they are. Transport Way, Oxford.
Actually, no. I think I do know where they are. I think I might have driven past them.
Keep an eye out next time.
Yeah.
So, what are your thoughts on these results and the valuation?
I mean, I think a lot of these pharmaceutical companies are very difficult to understand, and I think the ones that are more niche, like Oxford Biomedica, even more so. We know with pharmaceutical companies that they have very high research and development costs, and that there are big risks associated. But when they win and they get a patent, they sort of often win big. I think probably for me and for a lot of investors, unless you're sort of a specialist and you can properly analyze these businesses, taking a basket approach with maybe some of the big pharma companies would probably be a sensible one, especially if you do see those the benefits from the industry. I think that would probably be the most sensible thing to do. But sort of as you've alluded to, I think it's probably the too hard pile, and even if you did buy shares and you understood it, I would anticipate high volatility with a company like this.
So if you were building your little basket based on these results, would you want Oxford Biomedica in the basket?
I probably wouldn't. I probably go for some, your Pfizers, your Modernas, Glaxo, Astra. I'd probably do something more like that than some of the really big boys. But I appreciate, something like Oxford Biomedica. You might see the bigger growth from a company like that if one of its something it has in the pipeline goes really well for it.
We might not actually cover it again, because it's FTSE 250 listed, and we normally take our stocks from FTSE 350 listed companies with the odd AIM stock like Boohoo thrown in. Because it's had such a big drop, so it's down like almost 2/3. It's now at a market cap of 500 million.
Oh wow!
Which is that must be one of the smaller stocks on the FTSE 250 now. So it might be about to drop out. And based on the fact that I don't think a lot of that revenue that's going to be disappearing is coming back, we might not see it again.
Yeah. Or it could be a target for an acquisition.
It could, but even then we still wouldn't see it. It wouldn't pop up on our radars for the show.
No, exactly.
Right. Okay. Should we move on to
a business that's is much easier to understand? Nestle. So not UK listed, but anyway, it's the owner of Kit Kat, Felix Cat Food, Häagen-Dazs, and Nespresso. They had their first quarter results out this week with sales of 22.2 billion Swiss francs, growing 7.6% on an organic basis, with volumes falling 2.4%, but prices being increased by 5.2%, with growth across nearly all geographies and categories, and the on-trade sales ahead of pre-pandemic levels. In the US, sales grew 9.9% to 5.8 billion Swiss francs, largely driven by price increases, but it did have some broad-based market share gains. In Europe, sales grew 6.9% to 4.6 billion Swiss francs, as volume and price increases contributed 2.8% and 4.1% respectively. In Asia, Oceania, and Africa, sales came in at 4.6 billion Swiss francs, which was a 6% increase, 4.3% of which was accounted for by price increases. In Latin America, sales grew 12.5% to 2.7 billion Swiss francs, with volumes up 4.7%, but pricing accounting for 7.7%. Brazil, Chile, and Mexico all saw double-digit sales growth, and confectionery was the largest contributor, with Kit Kat the best performing product. Greater China growth was driven purely as a result of higher volumes, with sales up 3.4% to 1.4 billion Swiss francs. And that was actually, there was a 0.5% drop in prices over there. In terms of valuation, Nestle has a market cap which equates to around 278 billion pounds. It trades at 25.5 times earnings, and it has a 10-year average of around 21 times earnings, and its dividend is around the 2.5% mark. I mean, I thought these results were actually really, really good for a consumer goods company. I think they're better than the similar results we've seen from Unilever and Reckitt. It is reflected in the price. It's traded at 25 times earnings rather than your sort of 17, 18, 19. But it's got exceptional brands and they have been performing better. So it's probably justifies that higher price. Whether I'd be buying shares, I'd feel a little bit uncomfortable at 25.5 times earnings, but it's a really high quality business. So I think it would be reasonable to take a position at this point and hold it for the long term. And companies like this, even if you look at its 10-year average, they're never cheap, because you do have to pay up for that quality. I'm sort of, I suppose, sitting on the fence, but I think it's a great company and good results. What are your thoughts, Sam?
Very, very similar to you. I think these are fantastic results. Really, really good. I mean, these are the kind of results you want to be seeing from Unilever. Like if I was a Unilever shareholder, I would be pointing to these results and saying, well, Nestle are doing it. And they're not, and I know Unilever is like much more emerging markets, but sales in Latin America are up 12.5%. Yeah. They are doing it in the emerging markets as well. They're not just doing it in like North America. And when you look at Unilever's brands, I think they're as good as the Nestle brands. So why, for me, it's just the difference between good management and bad management. These are really, really impressive results. They're doing everything right. Unfortunately, it is reflected in the price. I would not pay 25 times earnings for it. It's just too much. It's just, I mean, I don't know, like if you pay 25 times earnings for this business and in 5 years interest rates are at 5%, you're going to get hammered. You might have bought a fantastic business, but it's just too expensive. And I think the dividend yield's quite low as well. So you can't even buy it and just say, well, I'll just do it for the income. Because at least with Unilever, you're getting a 4% dividend. I appreciate that's partly because the PE is much lower, but the 2.5% for me is probably not, it's just not, 25 times earnings is too high for me. But I think of the big consumer goods companies we've looked at, for me, this is probably the best of the bunch. And if you could get this at the same valuation as all the others, it would be the one you picked. And unfortunately, that's probably why it's got the higher price. But
market's efficient with it.
Yeah, so I can't knock the business at all. I just wouldn't pay 25 times earnings for it.
I mean, I think it's particularly impressive that they can just hike the prices by 5.2% and and pass that on to customers.
But we said that with Unilever. We said when we covered the results, I feel like they had the scope to up the prices more. They shouldn't have taken the hit on it, and they didn't. But then they're growing volumes as well, which they're doing that better than Unilever too.
But I think that it does come down to management.
Okay, should we move on to Netflix?
Yes. So Sam, let's hear it, because it's been all over the papers.
So our US company of the week is Netflix, and they have come out with their Q1 results. First quarter revenue rose 9.8% to $7.9 billion, and that compared to 24.2% growth last year and 16% last quarter. This is thanks to a decline of 200,000 subscriptions due to increasing competition and the rising popularity of less profitable shared memberships. Operating income was ahead of expectations at $2 billion due to lower than forecast content spending. New subscribers are expected to decline by 2 million in the current period, leading to 9.7% revenue growth. Operating income is also expected to fall to $1.7 million, but the group continues to aim for operating margins of around 20% at the full year. Management said the pandemic-related surge in usage muddied its view of the business and said it will look for ways to re-accelerate growth and address the membership sharing issue. Shares were down 25.1% in the pre-market, and I think they might have even been lower in the day. They might have been down as much as like 35% at one point. So if we break the numbers down a bit more, the number of new paying subscribers fell by 200,000 in the first quarter, bringing the total to 221.6 million. This is in part thanks to the suspension of services in Russia, which was responsible for a 700,000 decline in new subscribers for the first quarter. A price increase in the US and Canada meant new subscribers fell 0.6 million as expected. Higher subscription fees helped average revenue per membership rise from $14.25 to $14.91. This helped revenue for the segment rise 5%, down from 9% in 2021. Excluding the impact of Russia, Europe, Middle East, and Africa gained 400,000 new subscribers, and average revenue per member was constant at $11.56, with revenue rising 6% to $2.6 billion. Latin America saw a 400,000 decline in new subscribers, reflecting the impact of price changes and macroeconomic weakness. However, average revenue per membership rose nearly a full $1 to $8.37 as changes to membership sharing pricing structures were trialed. This led to a 20% rise in divisional revenue to $998.9 million. The Asia Pacific region saw subscriber numbers rise by 1.1 million, although average revenue per membership declined from 9.71 to 9.21. This meant revenue rose 1% to 916.8 million. Netflix spent 3.6 billion on content additions in the period. Free cash flow rose from 692 to 802 million, reflecting the increased profits. This includes 125 million spent on visual effects and gaming acquisitions. The group also announced plans to acquire Next Games, which is expected to complete in the second half of the year. Net debt was 8.6 billion. In terms of the valuation, the company now trades at a PE ratio of 29, and that compares to a 10-year average of 114.4. My view, so I think for these results, the 200,000 decline is not really that bad, because if you strip out Russia, it's actually a 500,000 increase. The problem's the guidance, because you could have looked at that and said, well, maybe it was a one-off because of Russia, but if they're going to lose 2 million more in the current period, then it's not. I've seen a few people on Twitter talking about these results and sort of speculating that the decline in subscribers is maybe like a good indicator that the US might be going into a recession. I don't know if that's true or not, but I can see how, when you're paying $20 a month and you've got a few of these different subscriptions, if you do need to cut back a bit, that is one of the things, especially in an inflation environment, that's one of the things you're going to look to cut. I don't think it necessarily does indicate the US is going into a recession, though. I just thought it was interesting. I think it's interesting as well to speculate what impact this will have on the Disney figures, which I think come out next week. My view is Disney will probably have increased market share. I think Disney is at a much lower price point and is still very much in growth mode. And it's, for me, got much better brands. And I think when it is so cheap, it probably, for a lot of families particularly, it probably is a stickier product. So I mean, Disney's been hammered the last few months since we last covered it. I do not think Disney's results will be in line with Netflix's. I think we'll continue to see growth in Disney Plus, but we'll find out whether I'm right or wrong next week, probably. I think the valuation's looking quite reasonable, actually. I would back them to go back to growth. I think when you look at the scale of the business, 200 million subscribers, I mean, how high can they go? Like, I don't know, maybe they're not going to get to 1 billion subscribers, but I think it could be a lot higher than 200 million. I think at a PE of 29, there's probably enough growth left in it that you could actually look at that and say, well, that's quite reasonable. The only thing is, if I am paying at a PE of 29, there's probably other businesses I'd rather invest in first. So although it's probably the most valuable, I think last time we looked at it, it was at a PE of about 50, and it is a lot more reasonable now, I think. But there's just other businesses I would rather own. So, for example, I would always want to own Disney before I own Netflix, because you're getting them, you may be getting the streaming businesses for a similar price, and then Disney has all this other stuff thrown in, and it's got all these wonderful brands that feed off of each other in the different parts of the business. It just straight, and Netflix doesn't have that. It is just the content side. But I think these results, they're not ideal, but I don't think they're terrible, and I would back them to go back to growth. And they have said as well they're looking at doing an ad-supported model. And I was reading. What do you
think about that?
Well, I was reading something the other day where apparently, like, Disney was saying that they've looked at the numbers for Hulu, and for Hulu, the ad-supported model was the most profitable. And I think if they took the ad-supported model, it depends where it was as well. I don't think they're going to be necessarily rolling it out in places like the US. I think they'll just say we'll pay the $20 a month. But in a market like India, where it's got 1 billion people, I was reading somewhere like ad supported is the way to go for that, because otherwise the average revenue per membership is just going to be too low to justify the content spend. But say you get 100 million Indians on there, you're getting a lot of advertising revenue, and you can go out and spend that content to then keep. So I think in certain regions it makes a lot of sense. It was just, if they rolled it out everywhere, I'd be a bit more concerned, because I think in the US there would be people that would say, well, actually, I can save $10 a month and maybe watch the odd advert. I think they should keep it to certain markets, more like emerging markets and stuff. So I've gone a bit of a monologue. So what do you think about these results and the business?
I mean, I think there's so much more competition in the market now than there was before, and you've got HBO, and like you say, the big one of the biggest players is Disney Plus. So it's not like it almost had the monopoly. It's not like the monopoly it really enjoyed before. And then I suppose the other thing is that with any company like this, where it's so highly valued and then it doesn't quite meet expectations. And I mean, in Netflix's case, is particularly when it's very sensitive to the number of subscribers it has, when that drops off, you see these big falls like 20-30%. But as a business, I think it still has a lot going for it. But I think in the short term, with all of the competition, and I suppose people being more cautious with discretionary spending, it could suffer. So it's difficult. But if you do, I suppose, boil it down to the quality of the content, Netflix does have a lot of very quality, original content that it's producing, albeit it's expensive to produce. So I think it's difficult to know how it's going to sort of pan out going forward. I probably wouldn't be buying shares. I still think it's expensive, but historically, at least up to this point, it had delivered on it. So I don't know what the current numbers are a sign of, and what I suppose what the future holds. I'd be much more comfortable buying Disney, which I already hold, and I'd probably consider topping up on Disney. I'd be bullish ahead of the results, but like you say, we'll see next week.
So do you think these results are an indicator that Disney Plus subscribers are going to be going in a similar direction?
Do you mean falling back?
So do you think Disney results would automatically follow? So they'd have a small decline?
Not necessarily, because I think Netflix is more mature from its streaming than Disney is.
It's more expensive too.
Yeah, so I don't think necessarily, and I suppose it would be a real test for the quality of the content and how much people are willing to pay. Like you say, how sticky it is.
Yeah,
and whether families can give it up or not.
It's probably easier to give up the Netflix if you're a family, because the Netflix is more expensive, and the kids probably would prefer the Disney library.
Yeah, and you get Star with it, which has a lot of just sort of like general popular TV shows on it. It's not just what you might imagine as cuts of cartoons, and you've got Marvel and you've got all the rest of it.
Whereas I think
Star Wars.
if you've got a household of just 2 adults in, maybe the Disney Plus is going to go if you're cutting back spending.
Yeah.
Whereas I think if you've got a household with kids in, for me, I'd be cutting the Netflix before the Disney Plus.
Yeah. And then, I mean, Disney, like you say, it's got lots of other parts to the business. It's not just the streaming, which obviously is pure play with Netflix. Right.
So of the 6 companies we've talked about this week, Tesco, easyJet, ASOS, Oxford Biomedica, Netflix, and Nestle. If you had to buy one, which one would it be?
Oh, I think it's a little bit tricky actually this week. I think out of these companies, if I were paying up and holding for the long term, I'd probably go for Nestle actually. I think it's really high quality. It's a bit pricey at the moment, but if I were buying any of these companies today, I'd probably just pay up and go for Nestle.
See, I didn't think you'd say that. I'm surprised. I thought we were both going to say Tesco.
Oh, Tesco, okay.
So yeah, Nestle is for me the best business we've looked at today, hands down. But I wouldn't be comfortable paying that, so I'd probably just pay the 12 times earnings for Tesco,
which is half the price.
Yeah, I'd maybe have considered ASOS, but I just think Boohoo's the better business, and because I know that, I probably wouldn't want ASOS. If it was Boohoo, it then be a different discussion. But yeah, it'd be Tesco for me.
Yeah, Tesco, albeit a close second, but I think for the long term, if I were to buy it tomorrow and forget about it 10 years later and come back, it would be Nestle.
Not like Tesco, which you did buy 10 years ago.
Yeah, nearly 10 years ago, I came back and I still made a loss. But anyway, it's a paper loss. I'm holding it. So one day it'll turn into a profit, we hope. Okay, well, thank you for joining, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.